Gold has been doing well in recent months, but I don't even think this is the first inning of what we're going to see. Gold is doing well, but really shouldn't be doing well. For gold to do well, you need to have the real rates that go down. That either means the rates are coming down or inflation goes up and the rates at the same level. So real rates coming down, gold goes up. We haven't seen that yet. What I think is really going to drive the gold price, again, central banks are buying. There's clearly now trend has been established where the central banks are moving away slowly, but has huge impact, moving away from reserve currencies in the US dollar and into gold. And if they keep doing that just a little bit, it can have a massive impact on the gold price.
As of May 2024, the gold market continues to exhibit some volatility. While prices haven't reached the record highs seen in 2011, they remain significantly higher compared to the pre-2008 period. The long-term trend suggests gold retains its appeal as a valuable asset during economic instability. From a technical viewpoint, SimonMarcotte emphasizes the need for urgent action to control deficit acceleration and mitigate currency devaluation. Despite the sizable debt, he underscores the context of surging household wealth, surpassing the national debt. Regarding the trajectory of the gold price, Marcotte's prediction emphasizes the pivotal role of central bank actions, specifically their movement towards diversifying reserves into gold. In recent years, the purchasing of gold by central banks has increased as some countries seek to diversify their reserves into safe assets. These sanctions imposed on foreign investments, similar to those enacted by the US and Europe against Russian resources, have prompted a reassessment of currency reserve strategies, affecting gold demand. In SimonMarcotte's estimation, the recent robust performance of gold may merely signify the dawn of an extended bull run. Envisioning a future scenario, the analyst anticipates that gold will gain substantial momentum as real interest rates begin their descent, a trend he attributes to credit contraction and heightened spending imperatives. At the same time, Marcotte states that equity prices and valuations will adjust accordingly. Gold rallied as traders reacted to the U.S. The inflation report indicated that the inflation rate declined from 3.5% in March to 3.4% in April. Traders were worried that the inflation rate may increase. U.S. dollar and Treasury yields moved lower after the release of inflation data, providing significant support to precious metals markets. Furthermore, Marcotte underscores the prevailing buoyancy in the gold market, attributing it to heightened central bank acquisitions and escalating Asian demand, notably spurred by apprehensions surrounding the weakening yen. Now we present the clips of SimonMarcotte's insights from his recent interview with Kitco Mining. Before we continue to delve into this discussion, please subscribe to our channel and activate the bell icon for timely updates.
Gold has been doing well in recent months, but I don't even think this is the first inning of what we're going to see. Gold is doing well, but really shouldn't be doing well. For gold to do well, you need to have the real rates that go down. So that either means the rates are coming down or inflation goes up and the rates at the same level. So real rates coming down, gold goes up. We haven't seen that yet. The gold is going up right now because central banks are buying. I don't want to dive into why, but I wouldn't bet against them. And also there's been a lot of Asian demand for gold. And to me, that's very clear why. It's because the yen, which is a reserve currency, is deflating very rapidly. I mean, I don't want to say it's collapsing, but it's breaking down. The Central Bank of Japan is having a hard time to maintain its currency. So anyone in Asia who's seeing that is flowing to gold. And so that's just the start, because as soon as the real rates starts going down, and they will, then gold will pick up momentum. And I believe that's where equity price and equity valuation will play catch up. And I'm a firm, so either you have higher inflation, but the real estate market is not going to be able to sustain higher rates. Therefore, real rates going down, gold goes up. But I would bet that it's actually rates that are going to be coming down. Why is that? Well, inflation is more or less much more under control than it was recently. But now credit is collapsing. The credit is contracting very rapidly. That's why we have big deficits, to counter that. But it can't keep going forever. So in order to re-expand the credit, the Fed's going to have no choice but to cut rates. And also to cut rates would help the yen, right? We need the world to stay pretty much in order. So I would bet that currently there's going to be more cuts than the market predicts. There's no doubt that the deficit is accelerating fast, and we need to get this under control. I'm not the one that would say that we have a debt crisis. And that really is not necessary to have a much higher gold price. What you have is currency devaluation. So currently, but the debt is sounds big, but we need to put things in perspective. If you look at the household wealth that has been created since over the last 5 years, since 2019, and I'm not talking about wealth companies, I'm talking about household wealth. That wealth went up by more than the current entire U.S. debt. So, it helps put things a little bit in perspective. So what I think is really going to drive the gold price, again, central banks are buying. There's clearly now a trend has been established where the central banks are moving away slowly, but has huge impact, moving away from reserve currencies in the US dollar and into gold. And if they keep doing that just a little bit, it can have a massive, massive impact on the gold price.
Regarding the current scenario, SimonMarcotte drew parallels with past instances, such as the undervaluation of oil stocks in the late 90s. Despite the robust performance of gold, he expressed surprise at the undervaluation of gold equities. Marcotte anticipates that once real interest rates start to decline, gold equities will eventually catch up in valuation. Historically, gold equities have tended to deliver 2 to 5x leverage during gold bull markets, as demonstrated in recent upcycles, notably in 2018 to 2020 and 2015 and 2016. As the new cycle gains pace, we note that gold equities are recovering from extreme lows relative to gold in broad markets and remain far from their historic highs. Marcotte suggests that there are too many junior mining companies and emphasizes the importance of consolidating deposits to create standalone projects. Furthermore, he predicts this strategy will attract attention from larger companies seeking significant acquisitions to replenish reserves. Let's get back to the interview.
You also mentioned equity price. So it's interesting because the price of gold, as we mentioned, is doing quite well, surprisingly well, if you ask me. The gold equities are very, very cheap, right? And that reminds me of the oil stocks in the late 90s. The oil stocks were extremely cheap on an NAV basis in the late 90s and early 2000s. And it's because the market was not believing the higher gold price. At the time, oil was about $12 per barrel. And the market was saying that is not sustainable. The world cannot run with oil above $10. And we had an eclipse recently, which means the Earth is still going around the sun. and oil ended up going to $140 ultimately. But in the early 2000s, the oil stocks were pricing $10 a barrel at the most because they didn't believe into that rally. I think we're in the same position now. The market is not paying for the gold rally because the real rates have yet to fall. When that happens, again, I believe that you're going to see momentum pick up in gold, and the gold equities will start playing catch up in valuation versus the gold price. Yeah, absolutely. I mean, is there too many listed junior mining companies? Absolutely. I mean, most of these companies should be private. Most of these companies have assets that should be in the hands of prospectors, right? That will fund them privately. And what works in the junior space is, in mining in general, if you ask me, it is to build ounces. To build a mine is very hard, takes an enormous amount of capital, and it's a tough job. And there's a lot of, very often difficult hurdles, to put it like that. To build ounces is where you get the most value creation. And it's especially true right now to build ounces and get to a size that will move the needle for a larger company to acquire, right? So A larger company looking to replenish their reserves, as we discussed, doesn't want to buy 12 small mining companies. They want to do one acquisition that will move the needle, that they can spend time on, and really make a difference. So the model, I believe, right now is to focus on building ounces from a deposit that is almost a standalone project and make it a standalone project. But what we're doing at Northern Superior is not a new strategy. It's to consolidate the camp of Chibougamau. The camp of Chibougamau had, 6 or 7 companies owning all of the relevant deposits there. And those deposits are so close to one another that it's obvious that they should see. Just fast forward 2 or 3 years since we've been at it, and the entire camp of Chibougamau now, at least all the relevant assets, are owned by either us or IAMGOLD. Clearly, IAMGOLD is now turning its attention towards that camp, as evidenced with the recent acquisition of Vanstar, who were their JV partner on the Nelligan deposit.
Gold's bull market can be attributed to several factors, including negative real interest rates, expanding government debt, and ongoing de-dollarization efforts. Most experts recommend keeping a 5 to 10% allocation to gold within a diversified portfolio. This level of exposure provides inflation protection without overexposure to a single asset. How will these evolving trends in the gold market impact broader economic sentiment and investment strategies moving forward? Drop your thoughts in the comments section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.